Stop messing around, stop fooling around, stop delaying, stop procrastinating. Get up, get out, get it done. Everything is possible, nothing is a problem, and anything can be overcome. I just get my ass up out of bed, I get my shit together, and I get out and I start the fight. And that will transform you from a mere mortal into a superhuman being. I've never, ever, ever met anybody who told me that they got rich watching their IRA or their 401k.
All right, welcome back to the Daily Cash Flow, Peter. This is episode 90. We're coming in on 100. That's pretty amazing. I just wanted to bring up this video, this Balaji Srinivasan video that's been going around the internet. You saw that?
I saw it. It's a great discussion. This guy presents information and possibilities in a really clear and concise way on really important topics that my guess is, George, 99% of the general public doesn't tune into, doesn't index towards, doesn't know about, and isn't talking about.
Yes. So for our listeners, I want to give them a little background. So,
please.
Balaji Srinivasan is he's the former chief technology officer at Coinbase. He was there from the beginning. And then he made a bet with James Metlock, who is on Twitter. He's like a Twitter pundit. He's a self-proclaimed tax enthusiast. They made this bet back in March that if Bitcoin failed to hit 1 million within 90 days, that Srinivasan would send 1 million in Circle stablecoin, which, for listeners that don't know, that's like a digital currency that's backed by cash. And he would send that to Medlock. And so 3 days ago, May 2nd, Srinivasan said the bet had been closed out by mutual agreement. And he ended up giving $500,000 to charity, $500,000 to Bitcoin core developers, and then $500,000 to Medlock. And essentially, he put out this video, which we're talking about now. He said, I burn millions to tell you they're printing trillions. And essentially, he was doing this to raise awareness that he sees a fiat crisis happening and, a bigger crisis coming, really.
George, people don't even know what a fiat crisis is. If you're to poll the world right now, most people aren't going to know what you're talking about.
That's true.
This guy breaks it down. Can we just get to it? You gave a nice lead in. Yeah. Let's just get to it. I want people to hear what we're talking about.
I just burned 1 million to tell you they're printing trillions. So the reason that I did this is I wanted to tell you in a provable way that to send a provable signal that there was something wrong in the economy. I'm not the habit of just burning.
We've been hearing that
for the sake of it. There's something wrong in the economy, and the state isn't telling you about it. And things could unwind very fast. Yes. And just to give you a sense of how fast, well, it was 2 days from the collapse of SVB to the government printing $300 billion.
Good point.
It was 2 weeks for $500 billion to make its way out of local banks seeking safety.
Good point.
It was 2 months from patient zero of the coronavirus hitting the U.S. After weeks of denial, suddenly lockdown came in March with very little warning, so just 2 months.
Fair enough.
It was 2 quarters from when Ben Bernanke said it was going to be only a mild recession in 2008.
I remember it well.
To the global financial crisis being acknowledged as such in September 2008. And it was 2 years for the USSR to go from superpower to total collapse.
So, George, he's referencing certain points that have happened in our current events and society over the past 15 years or so. And he's trying to remind us, guys, stuff can happen quickly. One singular event, if it occurs and it's a negative impacting event, it can happen quickly and it can really impact all of us. So he's talking about coronavirus. It was 2 months when they discovered it to when it was a full lockdown. 2 months. It's pretty fast. Yeah. SVB Bank, 2 days, right? So any one of these examples he cited was really a quick amount of time. 2 days, 2 weeks, 2 months, 2 years. He's talking about Russia going from a superpower to not being a superpower. 2 years. Yeah. I mean, that's pretty fast if you look at superpowers and nation states and how they evolve and decline. 2 years is pretty fast.
Absolutely.
So let's continue. I want to hear more about what he's saying.
The thing is, right now in the economy, many things are breaking at once.
Many. There's not just one singular event happening right now. There's many events happening right now.
Let's start with the debt ceiling. This is perhaps the most unambiguous, the one that everybody agrees on.
Yep.
You have markets estimating a record high probability of sovereign default for the U.S. You have former Treasury Secretary Larry Summers saying there's a 2 to 3% chance of this happening. You have journalists at the Washington Post saying, hey, just the fact that we managed to get through this in 2011 doesn't mean we're going to get through it today. And that's just the crisis that everybody acknowledges.
Let's talk about this. Sovereign default. All right, everybody, what does sovereign default mean? What? Right. Not many people know. We don't talk about it enough. Sovereign default is the United States having no ability to pay its bills. It's a complete shutdown. And he says just because we got through it in 2011 doesn't mean we'll get through it now. Why? The metrics and the numbers are completely different now. 2011, our debt and our GDP and our obligations were one thing, and they're a completely different thing now. And now, with the metrics being different, it's also happening and unfolding in a completely different venue and set of circumstances in our economic society. This is the one thing that everybody widely agrees upon. We have too much debt, but they keep raising the debt ceiling. They keep printing more money to be able to meet our debt obligations. And it's the printing that he's alluding to, which is really the problem here. No matter what side of the aisle you reside on and what your personal economic beliefs are, and if you're a business owner, or if you're an employee, or if you're an immigrant, or if you're an American national, or whatever the deal is, we just have too much debt. I think he's correct to point it out like that because we're looking for commonality, right? I want as many people as possible to understand these things and to talk about these things without dismissing them as, oh, that's just rhetoric from the other side, or, oh, that's just, the media's agenda, or, oh, like, we have a lot of debt. It's a problem. We're not going to be able to pay it as early as June 1st, right? Today's May 5th. June 1st, they're talking about sovereign default. Sovereign default. America can no longer pay its bills. I mean, think about what can happen if the person that owes you money and has to pay bills can no longer pay you. Think about the string of events that will occur. So this is a big deal. It's looming in front of us. We're on track. The train is headed towards the brick wall. Will it crash or not? So let's continue on and hear more about what he has to say. I just wanted to set the stage for everybody listening. I mean, George, I feel like we're talking to the common person, the everyday, normal, regular person. There's 300 million people in our country. I'm talking to 99.9% of them. The other 0.01%, I think they get this kind of stuff. They're academics, or they're in the industry, or they're finance people, and they're really paying attention. But the rest of us need to pay more attention to this. Yeah. Let's hit play.
So with the banking crisis, Rubini is saying, basically very similar to what I've been saying, which is that most U.S. banks are technically near insolvency. In terms of dollar value of assets held, the failed banks are already comparable to 2008. And in fact, as of this week, they've passed them, with 3 of the 4 largest bank failures in U.S. history just happening within the last few weeks. Okay, this is not like a small thing. It's not isolated. It's not that the banking crisis is over. Stanford study found that there's $2.2 trillion in unrealized loss.
$2.2 trillion of exposure from the rest of the banks that haven't yet failed, that are on the cusp of potentially failing. So that's $2.2 trillion right there.
So, the issue is, though, if it's not just a debt ceiling crisis, not just a banking crisis, but wait, there's more. There's many more things that are breaking. So here's commercial real estate. Morgan Stanley thinks this could be worse than the financial crisis. Okay, 40% downturn.
How many trillions?
Injecting. Here's the bond crisis. So 2022 is the worst year on record for bonds in a long time. And that's because the government devalued lots of bonds, and everybody holds bonds, not just banks. Bonds were seen as a safe haven. That's a bond crisis, okay? It's not just banks.
Appreciate his data.
And that's why in The Guardian they're saying, is this financial crisis 2.0 where the safe haven isn't safe? Guess who else bought bonds besides banks? It was insurance companies. Insurance is under pressure. Life insurers, for example, 70% of their portfolio in this study was bonds. And if you remember AIG in 2008, when the insurance company fell, the backstop fell out. And of course, it's not just life insurance, it's other things. You might say, well, life insurance isn't going to pay out. Turns out that the collapse in life expectancy has broken a lot of actuarial projections. So life insurers are sweating for money, and it's coming out of portfolios that are underwater for, for the same
How many trillions?
Okay. How about the fiscal crisis? This is a partisan article, but it's true that there's $1.4 trillion in unfunded pensions.
$1.4 trillion in unfunded pensions. We talked about this with Chicago. We talked about this with New Jersey. These states have these obligations to pay these pensions to their state workers. They don't even have enough money in their coffers and in their budgets to pay their obligations to the previous workers, let alone the existing workforce. That's $1.4 trillion. I'm interested as he goes through this list. And as he presents his data, George, I'm keeping track of the trillions of dollars that are at risk. We heard 2.2 from the banking crisis. We're hearing 1.4 from the underfunded pension obligations. That's 3.6 trillion so far. I'm keeping a mental note as he lists the trillions, but I'm really interested in that number as he goes on. Please continue.
$1.4 trillion in auto loans. With
1.4 in auto loans. We're up to 5 trillion right now.
Student loans. So these were put on suspend for 3 years. You have $1.8 trillion as a
6.8
here, and payments are going to resume. You've got credit card debt. That's $930 billion.
7.8.
To roughly $1 trillion. That's also at all-time highs. And there's yet more things that are breaking globally. Okay, you have the Ukraine crisis, where that's $75 billion directly, according to the Council on Foreign Relations, and it's more than $1 trillion indirectly. How do we know? Well, it's $800 billion just for energy subsidies in Europe. 800 billion euros, about 700 billion USD at last exchange rate. So that alone is just this massive thing, and of course the indirect costs of all the businesses that are failing because of all the spiking energy costs. You have de-dollarization.
We talked about this.
We did.
Turkey, China, Russia, Saudi Arabia, some African countries. There's a whole list of countries that are trying to de-dollarize their nations and get them off of the dollar. They don't want to trade in the dollar. They don't want to recognize the dollar. They don't want to use the dollar. George, this process, I think, is massive. And I wish he would highlight it even more, perhaps separately from this video, but in a future discussion. George, if these countries go off of using and trading in the dollar currency, the US dollar, there's so much less demand for the dollar, it's going to crash our currency. We're going to have big problems.
Yeah.
This is exactly what Bitcoin was invented for, by the way. So keep an eye on that as a reciprocal effect. Let's continue on, but I want to point out we're at like 8 or 9 trillion right now of current at-risk exposure, plus the de-dollarization of our currency, which is massive. It's everything.
De-dollarization is happening at stunning pace, according to Stephen Jen at Bloomberg. There's China's yuan, there's India internationalizing its rupee. Many countries, dozens of countries, are partially or fully moving away from the dollar as a medium of exchange at a minimum, even if not as a store of value. Sovereign defaults are at a record high. Okay, so you have 14 sovereign defaults in 3 years versus 19 in the preceding 20.
14 and 3 versus 19 and 20. 14 sovereign defaults in 3 years versus 19 sovereign defaults in the past 20.
Yeah.
Look at the rate and the volume of sovereign defaults. And what did we talk about just a few minutes ago? United States, it's on its way to being a sovereign default nation. June 1st, as early as June 1st, it could cease to have the ability to pay its bills and its obligations. Sovereign default. This is big stuff. And as we wake up in the morning and brush our teeth and get dressed and go to work, we're not thinking about this. We got to be thinking about this stuff. Any one of these things is big enough to be concerning and should inspire us to strategize and make some decisions for our family, for ourselves, for our community. But you've got a whole list of things that he's discussing here. Any one of these things merits your attention and your time. And he's got 10 of them that he's listed so far, all happening right now. 14 sovereign defaults in 3 years versus 19 in the past 20. People pay attention.
High net worth people are already seeing this. High net worth institutions are seeing this. They're already moving assets or doing things.
So here's Alon
this other day saying he sees all the economic data in the world. He thinks the cemetery is filling up fast. Okay. And I think it's probably even more than a severe recession, but he's already there. Here's a map of millionaire migration. As of 2022, yes, people are leaving Russia, they're leaving China, they're leaving Hong Kong, and they're still coming to the U.S. as of 2022, but the numbers are way down. It used to be 10,000 plus millionaires coming to the U.S. in 2019. It's now about 1,500. It's an 86% drop in just 3 years, probably going to go negative. So millionaires are changing allocation and
Let's stop right there. Millionaires are changing location and allocation of their resources and their jurisdictions. We've been talking about this for several years now. If you tax too much, people will leave. If you overregulate and make it too difficult, people will just simply relocate. If there's a more favorable jurisdiction in which to do business and to be taxed a lesser amount, people are going to flock to that jurisdiction. He's recognizing it here, and he's adding that to the recipe, the mix, the formula, with all the other things that are happening in our world right now. Guys, you got to pay attention to this stuff. Again, you wake up, you brush your teeth, you get in your car, you go have your lunch and you do your job, and you come home and you have softball on the weekends. It's not enough. Pay attention. The time has come for you to pay attention. If you agree with this kind of thinking and it's concerning to you, take action that's appropriate for you. If you think, no big deal, I'm just a cog in a wheel, I'm too small, I'm just one person, I'm just going to go live my life, that's your decision, but it's a risk. I want people to be informed, and I want them to be aware of what's happening in this world. I'm so blown away by this video that this guy made, because he lists all of them. He didn't miss a thing. Let's continue.
Banks outside the West loading up on gold. It's a colossal central bank buying. Look at that curve. It's just up and to the right. And so billionaires, millionaires, central banks, they're all seeing something coming and they're allocating. Not everybody, of course, but some smart money is doing that. And so then, of course, the question is, okay, but when? Everybody wants to know exactly when things are going to happen. So I don't have a crystal ball. My guess is 10% months, 70% years, 19% decades, 1% centuries. Okay, I can give a case for each of those. That when I say 10% months, what I'm saying is, we have some serious crisis in months, or 70% I think it happens in years. And one way of thinking about this is sort of the, stay in dollars or exit spectrum. If you think the current status quo of printing can go on for an endless amount of time, the U.S. establishment de facto believes it can go on for centuries, then you stick on one side. If you are seeing fire alarms, you're seeing klaxons, then you exit, whatever that means to you.
So this is the crux of it right here, George. Do you think the central bank can continue to print on an ongoing basis ad infinitum forever? If you do, because this is the way our society's been since forever. They just keep printing more money. If you feel like that's just going to continue, then this whole discussion we're having is a moot point, and you can go about your day and enjoy your time and do the same thing you were always doing, because they're just going to print more money to save banks, to issue credit, to manipulate the quantitative price and easing and tightening and the price of money and interest rates. They're just going to continue to print. That's all they've been doing. If you think they're going to continue to do it, then you can exit this right now and go back to your day. But if you think that perhaps it can't continue for, I don't know, any one of a number of reasons, which we're talking about right here, the debt ceiling, the looming national default that's looming for June 1st, the war, the impact of inflation and migration of millionaires and billionaires and dollars, and the job markets and the labor markets and the political unrest and the division. Like, if you think that all of this is a little too much right now, maybe you've never experienced it or seen it or felt it or dealt with it before, pay attention. We're talking about it right here. Like, the printing thing, we saw it happen at the very outset of the pandemic. Print. Look, it's been happening before. I mean, we bail out banks and companies and airlines, and we excuse student debt, and we put a pause on paying student debt, and we forgive loans. And there's all sorts of things happening. We've never seen them happen before. They're happening right now. All of them. It's incredible. Guys, pay attention.
90% decades, 1% centuries. You should figure out what your own percentage is there.
Think for yourself.
If you think that all of this is totally stupid, and the U.S., of course, has infinite hit points and the Fed can print forever, then you're at centuries and you should ignore all of this. But if you have some probability that actually system collapse may happen sooner than people think, then you should, take appropriate action, whatever that means to you. And then, of course, the question is, okay, well, how could printing start so fast? How could this whole thing unwind in months or years? And remember when I said that we went from mild recession to financial crisis in 2 quarters in 2008? Just to give you a little bit of detail on that, here's how that went down. So March 16, 2008, massive bank failure. April 10th, 2008, Bernanke assures the world it's maybe a mild recession. September 15th, 2008, just 158 days later, okay, we're in the middle of the global financial crisis. And crucially, Yellen didn't warn you. This article came out years later. Yellen feared housing bust, but did not raise public alarm. That is what I'm doing at my own expense. I'm raising public alarm, okay? Now, if you fast forward, okay, the thing is, 15 years ago, collapse came in 158 days, but right now, is history repeating? Because in March of 2023, you have a giant bank failure where the Fed involved. In April of 2023, just almost 15 years to the day after these events of 2008, you have, again, the chair of the Federal Reserve getting up and saying it's going to be a mild recession. And God only knows how many days we have until, if and when, a fiat crisis happens. Is it exactly 158? Who knows? It's probably in the election year is when it might happen if political conflict gets to an extreme. But who knows? You really can't tell. What I do know is that when it does happen, Powell isn't going to warn you. He's still talking about a soft landing, okay, as opposed to hard landing. He's going to bring inflation down. It's just going to be a smooth ride, right? Already banks are dying. Things are blowing up. It's not really soft already. And as opposed to like a hard landing where it's bumpy. If you take that analogy of Powell as a pilot, and soft landing, hard landing, there's another possibility, which is crash landing, okay? Here's Powell. Here's the pilot. He's a pilot of the economy.
This is a little dramatic.
Dollars are floating around the cockpit. He thinks he knows
Powell in the plane with the dollars.
And you and I, we're just passengers on the plane. Okay, I don't have control over this economy. You probably don't. And the dollars are flying around the air. And so, if Powell is crashing the plane, and I believe he is, then the question is, how much time?
He could have spoken about this differently.
And I don't know. But I do know that when you're trading, yes, too early is the same as being wrong.
Too early is the same as being wrong. Too early is the same as being wrong. He's not talking about the decision you made. He's talking about the timing of the decision.
Hell is truth seen too late. And so I've sounded alarm. I've done my duty in my view as a citizen. That's why I burned $1 million to tell you they're printing trillions.
The most impactful thing I've seen on social media in a long time.
So I'm curious with this situation, we said, okay, if this is something, if you take stock and say, you lean more on the 10%, 70%, of months or years, something like this happening. What are the preparations? What are the steps? What are the strategies that we have to start considering depending upon what place we hold in society with this? Because obviously,
the answer to that's going to be different for everyone, depending on whether you're an individual, you're young, you're old, your age, whether you're part of a company. If you're talking, it's going to vary.
Yeah, and I think that maybe I'm asking not so much for you to give a prescriptive thing for all of society, but I guess maybe how are you thinking about it for yourself?
So I think the only answer, let's say he's right, and that all of these things, the student loan crisis, the looming auto loan crisis, the looming sovereign default, the debt ceiling, like all of this stuff. Let's say he's right. And all of these, I think he's right. I think all of these things are a crisis. They may not have gone over the cliff yet, but the balloon is being blown up to such a level it's going to pop. And for each one of these things, the sovereign default, the auto loans, the student debt, international purchasing and hoarding of gold, the migration of money and assets away from certain places and towards others. All of this is happening right now. If he's right, the only thing I can think of that saves the day is more printing. It's the only thing, because I don't know how you don't flood the system with more capability and allow these things to occur. Because I can think of a civil unrest with any just one of these things occurring, let alone, multiple things occurring. The de-dollarization, man, I think that's going to be such a huge thing, and they better get their act together with that and figure out how to handle these nations that want to come off using the dollar and whatever the existing relationships are with these nations and the import-export and the trade agreements and the military support and whatever we do with these countries who are de-dollarizing. Got to figure that out right now and get them not to de-dollarize.
Yeah, because I think that's what's difficult is certainly, what Balaji is saying here is he's, for himself, shifting more to crypto, more to currencies that aren't going to be affected by this so directly.
Well, crypto, that's an unknown, like who knows, whatever.
No,
with
of course.
Crypto. I offer the suggestion that this is exactly the type of environment that Bitcoin was made for and anticipated, in fact. Yeah. You've got $1, which is not valuable anymore. You have to put your value somewhere. So gold. Yeah. These countries are buying gold. Maybe some people are going to buy Bitcoin or something. Who knows with crypto? But you have to do something. Crypto's a big unknown, and it's so new. We don't know how it's going to play out with crypto.
No, I think that's why I bring it up. Is that it's hard. It's difficult to take in this information and then find actionable steps moving forward because so many things are unknown. The crypto answer is unknown. And so if you don't have a lot of capital available to you,
actionable steps, stop spending on things that are wants and not needs. Only spend on needs. Lock down your housing, lock down your health, lock down your food, lock down supplies of those things. Lock shit down. That's what I'm hearing. Yeah. Lock it all down, because you don't know if one or two of these bubbles pop that he's talking about. You're going to have, remember how you couldn't get toilet paper at the beginning of the pandemic?
I remember.
It's going to be like that, but it's going to be like that with money. Remember we talked about when Hurricane Sandy hit, no one could access their money because they couldn't get to work. And the electric grid was down for 9 or 16 days, depending on where you lived.
Yeah.
Right? People can last maybe 5 or 6 days without their basics. And they're neighborly and they're friendly. But once you get into the day 6, entering day 7, it's no longer like, hey, here's a jug of water. Hey, charge your cell phone on my generator. Now it's get the fuck out of my way. I have to get to work so I can get the money to pay for my kids' medicine and food. Yeah, and nothing will stop me, so get out of my way.
Yeah, we turn Walking Dead way faster than we...
Look, I'm not trying to be an alarmist. We've just listened to this video where this guy's discussing options. But me personally, actionable steps... Lock it down, stop on the wants, focus on the needs. That's a place to start for everybody. Yeah. Trim the fat.
Yeah. Yeah, and I think certainly with that, even if this is all wrong and Centuries is the exit for the dollar, then it's not going to hurt you anyway. Like those are all positive steps that will be, strengthen the resilience of your economic systems already.
Perhaps,
yeah. It's going to be crazy to, keep an eye on it, and wild to see.
Well, it's a great discussion, George. I want people to pay attention to this stuff because I said it before. We don't get it in our daily media consumption.
Yeah.
We don't get it in our schools. We don't get it when we talk to our peers. When we go to work, we don't get this stuff because we're just busy with work.
Yeah.
This is the kind of dialogue that's going to make us think. It's going to expand our minds, and it's teaching us about what's really happening out there on a day-to-day basis. People read, oh, SVB collapsed. And then they go on with their day.
Yeah.
But what else is happening and how does it impact you? I want people to understand this stuff.
Yeah. Yeah, and certainly from a historical standpoint, I think it's useful to start just being aware of how all these different forces are not conspiring consciously, but certainly will conspire to affect your life individually.
It's like when you go into the hospital with a respiratory problem, and it's like everything else is fine. You're strong as a bull, but you just sort of have asthma or something, right?
Yeah.
And then you get to the hospital, and then all of a sudden you get a brain aneurysm, and then all of a sudden you fall and break your leg on the way to the bathroom, and then right, et cetera, et cetera. It's like that's what he's offering could be happening right now.
Yeah.
Right. It's not just the aneurysm. It's not just one thing. It's not just the sovereign default that's coming up perhaps on June 1st. It's this collection of things that adds up to trillions and trillions and trillions of dollars in exposure for our national and global economy, which he's offering. We couldn't sustain it.
Yeah. Well, and I think
we can't handle it.
Yeah. I'm fairly certain that's a moderate way to put it. Yeah.
So it's important stuff. We don't get the opportunity to consume and digest this type of dialogue. I don't know why, but we're here to try and reverse that.
Yeah, well, I think most distributors of information in that way are not incentivized to give this kind of clarity on subjects like this, I think.
And he uses data. This is a data-driven discussion. This is not opinions. This is not... And he's saying, look, you make up your own mind, but it's data-driven. He shows charts and graphs. He cites facts.
Yeah.
Good stuff. So... Yeah. Good luck, everybody. You got to consume this stuff. You got to read about it. You got to listen to it. You got to know about it. Get in the discussion, man. Get a seat at the table. This is how you do it. I don't want to be absent while the things that impact me and my life are being decided by other people. I want to be present. I don't want to be asleep at the wheel when there's decisions being made and policy being set and behaviors happening which are going to shut down my access to my money so I can't go buy my food for my family. And I don't want to be absent for that. Man, I want to be at the forefront of that. I want to be at the table when it's being discussed. Where do you want to be? You want to just be asleep, idly just drifting by while the events that happen that impact you are just unfolding before you without any control or understanding or input from you? Man, that's not me. Is that you?
It's not me, but I think it is for a lot of people the way to go. I think a lot of people choose that path. So yeah, hopefully we can all find a little more agency moving forward.
Agency.
Yeah. So Airbnb, there's this South Korean Airbnb host was handed a $640 utility and water bill after a couple left the gas and water taps running for, I think it was like 20 days. And it was like in retaliation for they wanted to cancel and they couldn't cancel. I know you typically focus on more long-term housing, but have you ever had an experience like this? And like, what steps do you recommend property managers or owners to mitigate horrors like this? Yeah.
Listen, I am not in the Airbnb business for multiple reasons, but I'm in business. And in business, you have relationships, contractual relationships with many different people. Your customers are one of them. So this Airbnb host has a contractual relationship with their guest. The guest wanted to, you said, have an early cancellation, but the host wouldn't let him out. Mm-hmm. You know, I don't know. There's a lot that I don't know in the details here. Yeah. But look, if someone pays me a deposit and locks up my property and prevents me from seeking another customer and then wants an early deposit, I don't know how quickly I would be to let them just cancel.
Right.
But I don't know the details here. Yeah. But I'll tell you what, I wouldn't be a jerk and turn on the water and the gas and just flood the house and cause a $640 water bill.
Yeah.
And I also don't know why the host wouldn't know about the water running. Like, where's his cleaning staff? Where's the manager? Where's someone else? Did he not have another guest that booked the next week? Like, why didn't someone say this and flag it to the owner? But look, in business, and especially in real estate, when we're renting space, and that's how we generate revenue. The strength of our ability to generate revenue is completely contingent upon the strength of our contracts, our lease agreements. So there's a contract here. Otherwise, you don't give access to your real estate to a guest to come in. You know, I'd love to hear more of the story one day about what the details were. If the owner was perhaps in default or in breach somehow because they misrepresented something and the guest wanted to get out of it, you know, that's different than the guest just randomly wanting to get out of a perfectly normal and good accommodating situation where the owner didn't do anything wrong. So I don't know what happened here, but I tell you what, being someone that rents property in exchange for revenue and income, I really rely on my contractual agreements. So whatever those say is usually how I behave. And I expect other people to behave the same way.
ChatGPT comes up again every day. Bloomberg reported that, right now. Bloomberg reported that ChatGPT is now, they're replicating the work of human quants in like decoding Fed reports and headlines to inform.
We knew this.
To inform trading decisions. Do you think this can be integrated to make a more comprehensive investment strategy? Like, what are fundamental strategies for investors to keep in mind when they're faced with, okay, there might be automated analysts coming in?
We've been dealing with automated trading programs and technology that makes investments and does buying and selling based on the inputs that are fed into it, data and metrics. I mean, that's not new. That's been around for a long, long time.
Yeah.
So I think this is just an enhancement of that very same thing. Look, for me, at the end of the day, I'd like to have some oversight as a human being with gut instinct, with feeling, and with sort of human capabilities.
Yeah.
But you know, this has been around. I think we're all used to it as a society. Our financial system is certainly used to computers and bots making trading and investment decisions. Mm-hmm. Can they mess up? Yeah, they can mess up. That's why I want the human element involved.
Right.
But sometimes you don't know if it's the human that's overseeing the technology or the technology that's overseeing the human.
Yeah.
And that's an interesting path forward with this discussion to see how that plays out.
Yeah, so that's what I wanted to ask is like, are there fundamentals to keep in mind as an investor when faced with
There's always fundamentals. There's always I mean, for me, I'm all about fundamentals. Yeah. I don't, you know, in my business, I don't use computers to tell me what to do. I look at data and then I digest it and I make decisions. So fundamentals are things like income and expenses, revenue, balance sheet, market size, market opportunity, cost of goods sold, supply chains, pricing for raw materials. I mean, these are inputs that you just can't get rid of no matter what industry or business you're in. And if you're trading and if you're trying to buy and sell stocks or equities or bonds or whatever it is you're trying to make a profit doing, all of those inputs impact that. I have to have some ability to digest all of this data in a human way for me.
Well, because I think that's the danger moving forward is, you know, if you have a system like ChatGPT or another AI system that you trust and say like, oh, well, they got it. They're decoding what the Fed is saying. They're decoding what the headlines are saying.
Trust but verify.
Right. I think that goes
cautiously
back to
optimistic.
Yeah, I love that.
You know, these things that allow you to have technology do some of the work for you, but you have to have checks and balances.
Yeah. Yeah, I've heard it described as an intern, a not bad intern. Like the, so,
intern.
Yeah, so okay. Like you always have to check their work. You always have to, you know, make sure to put your stamp on it. But that, yeah, it's helpful in some way. So, Bed Bath & Beyond, one of the infamous meme stocks from last few years, you know, they just recently declared bankruptcy.
They've been on the cusp of this bankruptcy for like a decade.
Forever, I know, crazy. And that's obviously why they were a meme stock. You know, that's why people were excited to drive things in that way. That's kind of what I want to ask you about is what's your take on the meme stock movement? I don't think we've ever talked about that.
Well, here's my take on meme stocks. It's sort of like Dogecoin was to crypto, right? Zero utility, zero value. It was put up more or less as a joke, and people started trading it because they enjoyed the jokiness of it. And meme stocks, I mean, it's the same thing. There's no fundamental value in Bed Bath & Beyond. We can see historical downward trending metrics. We can see that they weren't able to compete with their online sales, and they didn't pivot when the pandemic occurred to building up a more robust online sales presence. Like they missed that whole boat. They've been teetering on this bankruptcy for years, as far as I can remember. They're selling stock that they own to generate cash to avoid a bankruptcy, which is inevitable anyway. I mean, there's been nothing good about the Bed Bath & Beyond story. So I don't have the fundamentals to trigger an investment. But as a meme stock, you don't care about fundamentals. I mean, it's not how I roll. But if you want to, I mean, a meme, it's complete gambling. It's like blindfolded gambling, meme stocks. I mean, it's even a joke phrase to me. I can't take it seriously. And I can't take anyone who invests, because it's not an investment, it's a gamble, in meme stocks seriously. There's no intelligent discussion to have around these meme stocks. George, the fact that there's even the word meme in front of the word stock implies a certain lack of credibility and a complete level of jokiness that I can't buy into. I need fundamentals. I need pure, sound, simple, time-tested fundamentals for me to engage in a dialogue, make an investment, make a decision. There's none of that here with a meme stock. There's none of that with Dogecoin. It's all bullshit. So I'm a hard pass on that stuff.
Hard pass. I like it. Sticky rents. Rent growth is 17% higher than 2021 levels, according to rent.com. I don't know if that's accurate.
What markets, what asset class, but
yeah,
continue.
Exactly. Yeah. But the Morning Brew recently put out an article that speculated that this was not, in fact, due to institutional investors restricting supply, but claiming that rents are lagging indicators and that
it was not, in fact, due to institutional investors restricting supply. I mean, there's a lot to unpack right there.
Yeah,
but
absolutely.
Please go ahead. I mean, I don't even know what that has to do with the price of tea in China, but I'll get to it.
Yeah, and that just almost every indicator except for CPI was indicating that rent growth has peaked. That's what they're claiming or speculating.
So yeah. Are we talking about single-family homes? Are we talking about multifamily? What are we talking about?
So that's the thing. I don't think they specified. I think it's the asset class is all at large, multifamily,
so
just rental.
You can't just have a discussion about rental, right? Because that's like having a discussion about construction materials are so much more expensive now. Well, no, lumber was, and then it came back down, and many more examples. I mean, there's things, it's still very hard to get a Viking fridge, right? And that's expensive. But you can't just say rental products more expensive. You have to break it down and segment out the market by product type and by location. So in multifamily, in many markets, we're seeing some growth. It's not as much growth as we saw the past couple of years. The data that I'm seeing implies that in the Northeast, rents are up. They're not up as much as they were in the 12-month period last year, but they're up a little bit now. I mean, we were seeing 20, 25% year-over-year rent growth. And now I think we're down to perhaps 10, or 12 or 17. I heard New Jersey, Central Jersey was 17. That's my market, is New Jersey. You have to talk about whether it's multifamily or whether it's single family. And you mentioned something. You said that the Morning Brew said, oh, it might be or it's not. What did the Morning... You mentioned something about the Morning Brew, how they inferred that it was institutional investors restricting supply. Let me tell you something. First of all, in any market, especially the rental housing market, it's the buyer that determines price, not the seller or not the property owner. It's the buyer 100% of the time. If the buyer wants to rent and they agree to the price, they sign. If the buyer doesn't want to rent, they reject it and they look elsewhere. That's the beauty of a free market, George. The buyer has the power, the buyer has the control. So there's this discussion about how the sellers or the property owners are creating these high prices and forcing buyers to sign leases. Well, it doesn't really work like that. The buyer is the one that ultimately has the decision and makes the decision if they want to set the market price. Look, there's a negotiation that happens. There's a discussion. There's options to the consumer, and they can review those options. And that's what free markets do. It's better for the consumer. It gives the consumer more options, and the consumer can decide which way they want to go. But to say that institutional investors are restricting supply, I think the inference is to keep prices high. Look, in multifamily, if you have a bunch of vacancies, you want to rent these vacancies. We've talked about how you want to keep the contract rent high, but offer concessions to try and counter that. If you're asking $2,000 for an apartment, but you have 30 of these apartments in one building that are available, you can't just lower the price on all 30. You're going to kill yourself. And that's going to be not only bad for you, it's going to be bad for the consumer, and it's going to be bad for the marketplace. But you keep the product priced high at $2,000, and you offer concessions, you offer free month of rent, you offer different ways to motivate the buyer to make that purchasing decision or the renter to make the renting decision. George, in the single-family home market, the significant minority of single-family home inventory available for rent is owned by, I'm going to say, professional or Wall Street or institutional property owners. I think it's something like 3 or 6 or 9%. I think it's a little bit higher now because there's been a lot of activity, a lot of capital flowed into that sector so far this year. But it's not 50 or 60 or 80% of single family homes for rent are owned and controlled by these corporate or Wall Street landlords who are then deciding to restrict inventory coming online to keep prices high. I mean, that's just not the case. So to get into discussion about how supply is being withheld or warehoused so that it doesn't flood the market and create more supply than demand, we just don't see it. I'll tell you the one place where that happens, and we've talked about it before. In New York City, the rent-stabilized apartment inventory, there's a lot of vacant rent-stabilized inventory, which is not on the market. It's not rentable, and the property owners aren't making it rentable. Why? Because the legislative environment disincentivizes that and doesn't make it possible. So you've got these situations, and I mean tens of thousands of these. I'm not talking about a few or a couple of hundred or whatever, right? We're talking about tens of thousands of vacant rent-stabilized apartments that can't be renovated because the property owner can't recoup its cost to renovate. So you've got apartments that need to be brought up to code before a new person moves in. You've got to do lead abatement. You've got to do new plumbing and electric. You've got to redo the interiors and paint. It all has to be done professionally with permits. You have to do it safely. You're in an occupied building. You can't be disturbing other neighbors. I mean, this is very, very expensive to do in New York City. You can imagine it's like $100,000 or $150,000 to renovate one of these apartments. And when you do that and spend that $100,000 or $150,000, you do not get a rent increase for doing that. If the old rent was $800 a month, the new rent's generally going to be right around that same price. I mean, you don't get to now mark to market. You don't get a vacancy decontrol in New York. It's the single biggest thing that has killed the New York City housing market. And New York City has a lot of problems with its housing market right now. This is one of the major reasons why. So property owners are not looking to warehouse inventory and keep it restricted from entering the marketplace. They're not. I mean, think about it. They made an investment. They want to get their inventory sold. They want to get their products rented. They don't want to hold inventory. They want to get rid of inventory. They want to get their stuff occupied. So to infer that this is like a strategy, a long-term strategy that's going on with corporate or institutional or Wall Street type of property owners, I mean, it's a ludicrous assumption. And I see a lot of the liberal anti-business talking heads really latch onto this as a point. And there's even, I think, like an anti-Wall Street landlord bill in one of these states that's been passed. Or it's being discussed,
right? Yeah.
And they call it the anti-Wall Street landlord, or is something. I'm paraphrasing, but I can't remember the exact words. Yeah. Please find it and put it up and correct me, because I'm just remembering some of the vague details of it. But it's like it's a ridiculous talking point. In business owners don't want to hold their inventory. They don't want to warehouse it intentionally. Business owners and housing providers are in the business of putting their product out to get it occupied, and for certain types of people with certain agendas to infer and blast out in the media and other places that it's otherwise is, I think, irresponsible. Yeah. So I'd like to see also that Morning Brew piece that you referred to, where they mention it, because it's I'd like to learn more about it.
Yeah,
because I'm speaking to you now without having seen the Morning Brew discussion.
Yeah. Well, you mentioned the kind of the buyers being in control ultimately of
you don't want to buy, don't buy.
Right, exactly. And so that was something I want to talk about with buttons in cars. It caught my eye that car makers
buttons in cars. Are we talking about control buttons? Or?
Yeah. So instead of touch screens, that they're bringing buttons back into car manufacturing, like tactile, touch screens,
manual, old school, analog.
And this was not because of safety or because of kind of oversight. This was because of consumer backlash against touchscreens.
It wasn't because of safety?
No.
Because I could see the safety element being a big part of that discussion.
Yeah, I mean, I think it is part of the discussion, but I think...
Because they tell us not to text and drive, but they don't tell us not to...
watch TV on the touchscreen.
Futz with our 21-inch screens while driving.
Yeah, no, totally. No, and I think that's a valid argument as well. But I think the manufacturers that are, at least right now, putting in tactile buttons are saying that it's because of a lot of consumers have demanded this and said they want buttons.
This is not unlike any other business with any other relationship with its customer. You have to listen to your customer and be in touch with your customer and care about what your customer wants, and then you got to give it to them. So if your customer wants widgets, give them widgets. If they want gadgets, give them gadgets. If they want buttons, give them buttons. If they want touchscreens, give them touchscreens. I don't know. It's business 101 to me. You're saying the safety element is not part of the discussion. Okay, so it's just a preference, like a user preference. They want more analog, touchy-feely knobs and buttons and controls. So,
that's what I'm hearing. Yeah,
so give it to them.
Yeah.
What do you care? As a manufacturer of automobiles. Like,
totally.
What do you care?
Yeah.
You know? Like if I'm in business and my customers ask me for a purple polka dotted baseball hats, I'm going to find out what size and how many they want. Otherwise I shouldn't be in business.
Yeah, well, and that's what it kind of reminded me of that, what you said before, of like money talks, what do you want it to say? And that kind of being able to vote with your wallet and saying, well, what you purchase is kind of, the world that you create.
The buyer, the consumer, the end user has so much power and so much control. We don't understand that, and we don't practice that, but we really do. We like to think that all these other factors are just spoon feeding us products and the pricing that we have to deal with in our daily lives as consumers. We're not. Look, we can just go somewhere else, guys. The free market allows that to happen. This is why we have to let free markets flourish. Consumers need options so that if they don't like door one, they go to door two, and then door one dies. I want these crappy, Bed Bath & Beyond. I want them to fail, because I can go to Wayfair and I can go to Amazon and Target and Walmart and get a similar product at a better price, and it's a better experience. So why should Bed Bath & Beyond continue to exist when they just fail at delivering good value? I want these shitty banks to fail. Like, why should they be in a competitive environment? Why should a shitty bank be allowed to continue to go on and be shitty at the taxpayer's expense? Why should the federal government bail them out with our taxpayer dollars? Just let them fail, And that's what you get in a free market. And when those shitty banks fail, and when those shitty Bed Bath & Beyonds and other companies fail, the strong ones rise up, and it's better for us as consumers. Like, we don't have to go to Bed Bath & Beyond. I don't have to buy my vanity and my toilets and my towels at Bed Bath & Beyond. I've got options, and I have options because I'm in a free market environment. You have to let the free market environment flourish and grow and be strong. I mean, you have to. Because without there being a free market, I'm stuck going to Bed Bath & Beyond, and I'm stuck paying a high price for their shitty towels. And there's other options. You got to make the options available. So that's how I see it. If I want knobs in my car and the car I love doesn't have knobs, I'm going to look at another car. Plain and simple. The consumer, the end user, the purchaser is the one that dictates pricing. It's the one that dictates the demand, and it tells the companies what they should be doing. When a company gets into business, they don't sit around and pull all 100, hypothetically, of their new employees and say, all right, we just formed this company. What should we sell? And once we decide what we're going to sell, what color should it be? Like, they're not asking the employees that to start. They're doing consumer polls, and they're studying the marketplace and the demand. They're studying what the demand is because they want to feed that demand, appease that demand, and supply that demand. So they're asking customers what they want.
Right.
And then they're making the products that fill the needs of what the customers want.
Yeah.
That's how business works. That's how the free markets work. It's a great thing. It's a great thing for us as consumers. So I want to see more people understand that the consumer, the purchaser, the end user has the power, and flex that power. Exercise your options. There's many options out there for you. Go ahead and find the ones that are good for you and spend your money on those.
Flex the power, people. Thanks so much, Peter. Anything else you want to touch base on before we head out?
Nothing, George. This was a fun discussion. I really loved our analysis of the video. Balaji, Srinivasan. So tag the bejesus out of them. Make sure people see this. Yeah. They don't necessarily have to see our discussion of it. They can go look at his original broadcast. But it's important stuff.
Well, and I think what's exciting about this is, as you said, I think for people that are not typically following him or following people that are having this discussion, I think this is a good entryway to kind of understand some of this stuff. So
it is.
I'm excited for it.
Absolutely.
All right, thanks so much, and I'll see you next time.
Thanks, George.
If you like what you just heard, you can subscribe to The Daily Cash Flow on YouTube, Spotify, Apple Podcasts, or wherever you listen to podcasts. And we'd love it if you left us a comment or review. You can follow us on TikTok and Twitter at SiegelCap, and on Instagram at Siegel.cap. As always, if you're an accredited investor, go to SiegelCapital.com and take our survey to see if you qualify to take part in one of our apartment building deals. That's SIEGEL Capital.com.